Welcome and thanks for joining us. Our webinar today. Before we begin, just some quick housekeeping reminders. All attendees will be in listen-only mode, but will have an opportunity to ask questions to our speaker during the Q&A segment. You may pose your questions at any time during the webinar by typing them in the Q&A box. This webinar is being recorded and all registered attendees will receive the recording and be able to access the presentation on demand within 48 hours of this event. This webinar is titled How Gold and Crypto Are Reshaping Global Finance. My name is Marilyn de Guzman and I will be your moderator today. Over the past several years, digital assets and blockchain technology have grown rapidly, changing how value is transferred and stored around the world. At the same time, gold continues to play an important role in global finance, both as a traditional store of value and increasingly as part of the broader discussion about the future of money. Today's session explores how these two trends intersect and what that might mean for investors. And to help us unpack this evolving dynamic, it's now my pleasure to introduce our speaker. Ravi Sood is the chairman and CEO of Golconda Gold. He's a financier focused on emerging markets. Ravi was the founder and former CEO of Navina Asset Management, a Toronto-based investment firm that was acquired by a major financial institution. He also serves as director of several companies, including Blockchain Power Trust, Feronia, and Even Co. Previously, Ravi was a director of ICC Labs and Elgin Mining. Over to you, Ravi.
Thanks, Marilyn, and thanks everybody for tuning in. I'm really excited to share some thoughts today about what's happening with the world global money system and how it's changing. It's a really interesting time, really unique time with changes happening that we haven't seen or talked about in any of our lifetimes. I'm just going to share a presentation and with a few speaking points and give you a few graphics to think about as we go through the presentation. The key principle here is, or the key driving factor in what's happening with money in the world is the world's financial condition. And what I'm really referring to is the amount of indebtedness that we've racked up as a society. In particular, Western societies, the United States and Canada, Europe, but also Japan, virtually every country in the world. I'm fond of paraphrasing Ernest Hemingway in one of his characters asking, how did you go bankrupt? Two ways, gradually, and then suddenly. And that's very much what we're experiencing now. This global fiat system, no sound money, not anchored to anything. That system has been in place since 1971. And for the most part, it's worked. There have been some negative outcomes for sure. Has it led to outsized inflation? Has it unfairly supported certain elements of society and unfairly harmed others? Yes. But for the most part, it's worked. And the financialization of our economy, the flexibility that it's allowed governments, it has contributed to progress in many ways. So it has worked, and so those detractors of that system, they haven't gotten very far because there's been pushback who said, well, if it's broken, then why is the world still functioning? Why is the world's money system, for the most part, yes, it's not perfect. Why is it still functioning? Well, that's where it comes in gradually and then suddenly. So it's fine until one day it isn't. And that one day is really coming up on us fast. And those detractors, the voices are getting louder and being taken more seriously. And the pushback is now getting harder and harder. In real terms, like, what does this mean? So this, first of all, this is a little bit of a misleading graphic, but it's meant to be just to introduce some drama. We took centuries to get up to $1 trillion of debt in the United States, and then very quickly it's just gone asymptotic. I'm fond of pointing out it was less than $10 trillion of debt when Obama became president, and now we're going to push through $40 trillion of debt during this second Trump administration. So in real terms, it's exploded. In absolute terms, it's exploded. And I'll show you a little bit more relevant and less misleading chart here. And this is debt as a percentage of GDP. And so we show the previous chart, and you can draw whatever conclusion you want, but it is more appropriate to show that debt as a function of the size of the economy. And so here, this is in fact the more illustrative one, and we can see that, hey, wait a minute, we actually did get over 100% debt to GDP, and the United States didn't default. So that was coming out of World War II. Pretty different set of circumstances. So what were the set of circumstances? Obviously, the Second World War, but we were coming into the baby boom, a real demographic dividend. You also had the continuation of the productivity boom from industrialization, automation, and you had a huge peace dividend in this global infrastructure build out that was just driving industrial economies around the world, most notably the United States. So you had these huge tailwinds, but still, the exit path included a prolonged period of negative real rates. And what do I mean by that? We're talking about actual inflation significantly exceeding prevailing interest rates. So your real rate is negative, and in fact, dramatically so during this time period. You had a period where it was double-digit percentage negative real rates. And that deflated the real value of that debt. And ultimately, the economy grew its way out of it. And that debt as a function or percentage of GDP declined quite significantly. So that was a very successful exit. We'll fast forward to 2025, and we're breaking through to even higher levels on debt to GDP. Will the same recipe work? Well, it's not the same set of ingredients going into this. First of all, we're running annual deficits that are much higher. We have a huge trade deficit in the United States that wasn't present previously. And you don't have the same tailwinds. Sure, we are getting productivity gains from things like AI, possibly alternative sources of energy. Who knows what else is coming down the pipe. But you're going in without that demographic dividend, without the peace dividend. Perhaps we're even going the other direction in many cases. And you also are going in with a much more fragmented, polarized, split a country in the case of the United States, and increasingly so in Europe and in other major economies around the world. Harder to get consensus, harder for everyone to pull the oar in the same direction. So you're not going to have the same sort of unified political will to go in any direction to figure a way out of this mess. Not an insignificant factor either. And add all that up, you're still going to have only one exit path. And I'll talk about it, why that is and how you get there and how you implement that in just a second. But it involves negative real interest rates. And negative real interest rates means you're deflating that debt, certainly as a percentage of the GDP. You're causing huge inflation, and you're damaging huge segments of the economy. There's going to be a lot of suffering, and it's going to benefit a very small fragment of the economy, and it's going to really benefit real assets that are effectively hedged or protected or benefit from inflation. I like to reference or liken the situation and make a reference to Star Trek and a term called the Kobayashi Maru scenario. And this is meant to reference a situation in which there is no winning. A Kobayashi Maru scenario is, as we got the definition in front of you, an unwinnable or lose-lose scenario or situation. And that's what we find ourselves in here. So you have what I would characterize as an intractable problem, to use a mathematical characterization. No realistic set of inputs is going to let us grow our way out of this debt to pay it off through a combination of austerity, productivity growth, and normal course GDP growth, population growth. It's impossible. So that points you back to that negative real rate solution. And there is it's also a lose. And so it's just a different choice on how we lose. In my view, this is the best way to lose. And as I said, it's going to cause a lot of pain to the majority of the economy, and it's going to benefit a very small sliver. And the objective is to figure out how to be part of that sliver and be one of the beneficiaries of this restructuring of the global economy. So how do we do this? What is the solution if all of this is true? And the presentation's titled "Bullion to Bitcoin," and as I said in the preface, we want to talk about how the global money system is changing and what money means. And this is all happening at once, and it's all very much intertwined. So we've seen an experience coming out of the dot-com bubble, the global financial crisis, COVID. We've had different an on again, off again relationship with quantitative easing, forms of yield curve control. All of it adds up to the same thing: increasing the denominator, increasing that money supply, and manufacturing negative real rates. So we're going to grow the GDP by inflating the economy, by increasing the money supply, increasing that denominator, and we're going to make sure that interest rates are low. And even if Mr. Market says, you can set a policy rate that's very low, but sorry, I don't believe you, 0.5% or 1.5%, whatever the case may be, that's not the real rate. What are you going to do about that? It's going to need to be enforced. And that means the Fed or the equivalent institution out there enforcing it by buying securities in the market, driving the price of those securities up, driving yields down, and controlling it there, yield curve control. How do you pay for all those securities? You bring them on balance sheet, you're printing money, you're increasing the denominator, you're increasing the money supply. That is the path forward. And that is that's our choice of how to lose in terms of this Kobayashi Maru situation that we find ourselves in. And a final footnote almost to that, and it may be the final act and not the footnote, and the main act is what I'm starting to call magma. Make gold money again? Question mark. Is this part of the solution? Is Bitcoin part of the solution? Is cryptocurrency part of the solution? Let's talk about that. It's been sort of like a bit of a us versus them on the gold and the bullion camp versus the Bitcoin and crypto camp. And increasingly recently, they've sort of mixed and mingled where there's a lot of overlap. And we've seen cryptocurrency companies like the stablecoin company Tether making huge forays into gold. So very interesting to see what's happening there and questioning what does this mean and where's this going? And let's dive into that further. But specifically on, how do we make gold money again? Or does it even make sense to do this? Maybe it does. And we've been hearing things for the first time ever since 1971 and Nixon taking the US off the gold standard from senior officials on the public record in the US government administration, the Trump administration, which are endorsing sound money policy, specifically mentioning gold and endorsing gold as a possible solution for the situation that we find ourselves in, without giving specifics, but frequently referencing gold in a positive light. Just to highlight, people like Treasury Secretary, Commerce Secretary, people of that seniority have absolutely not cast gold in a positive light for the last 54 years. Starting in 2025, the current administration, very interestingly, has done so and has done so repeatedly. And that's all on the public record for all of us to see. And I think you have to wonder, has that been intentionally put on the public record? Is it telegraphing something? We'll only know with hindsight. But what does this mean if we remonetize gold? What would that look like? So, of course, we could ask what price and how, where do we set it? Well, I don't have a crystal ball, but let's have some fun with numbers here. If our debt to GDP on our current trajectory is, let's say, just to keep the math simple, 150%, 150% debt to GDP in 5 years in the United States, we have one kick at the can. So we don't want to remonetize gold, set a price, and try and in one fell swoop. Let's say before the end of the current presidential cycle in the United States, just to pick a time frame, i.e. in the next 36 months. We don't want to have to make one big, bold move and then realize that we undershot the mark. So we're not going to undershoot it. If anything, we're going to overshoot it. But let's use that number, 150% debt to GDP. And let's say that we're going to increase the money supply and we're gonna do everything we need to do to reset the system so that in real terms, that debt is now 50% of GDP, a much more sustainable number. Probably not as low as we'd like for a magic bullet one-shot solution. So that's us tripling the denominator, if you will, in simple terms, obviously more complicated than that. And on that basis, I would use a tripling on gold price. So that would get us to $12,000 on gold, just as a number out of the air, fun with numbers. As I said, we don't want to undershoot. We want to overshoot, if everything. We got one chance to rip this Band-Aid off, and we got to rip it off the right way and be one and done. And so let's say we overshoot and we go 4x on the money supply, 4x on the price of gold. And that, again, I'm oversimplifying things grossly. And there you're getting to $16,000. So talking about a price that's quadruple where we are today. This is more art than science. Let's not forget that. But in terms of direction and in terms of quantum, I think there's a lot of merit to this very simplified mathematical analysis of it. So let's say we're resetting, we're the US government, and we decide to magma and make gold money again. And we're resetting the gold price to $16,000. How does one do that? The Treasury currently accounts for gold at about $41 an ounce. That is the cost that it was, the price that it was accounted for 54 years ago. And through the magic of the U.S. Treasury accounting rules, there is a huge cash infusion by revaluing gold to market price, or to say an even higher price like $16,000 an ounce. So we do that, we get a huge infusion of cash through that revaluation. It's really money coming out of thin air, money printing, and that's on the order of trillions. So you do that. Let's say we do that in 3 years, the last year of the current presidential cycle. You have a budget surplus. You've now brought on the order of $4 or $5 trillion into the Treasury account. You've caused massive inflation, massive deflation of debt as a function of GDP. And you have now set this gold price at $16,000 an ounce, which you could enforce by printing money to buy gold ounces in the market and enforcing that ratio, much like we're talking about enforcing an interest rate level by picking a policy rate and then going and buying securities and driving the price up in the marketplace to keep that yield down to what our policy rate was. No different, another market mechanism to enforce it, another way of printing money and forcing ourselves into that negative real rate scenario that deflates that debt in real terms. Complicated in some ways, actually quite simple in others. And again, it's fun with numbers. So we're picking numbers out of the air and we're grossly oversimplifying this, but directionally and in terms of quantum, these numbers do make a lot of sense. So what does this mean for Bitcoin and for cryptocurrency? So is Bitcoin part of the answer to this? And I mean, the best answer I can give is maybe. I mean, it's from a personal perspective, I'm a mathematician by training. I have a love affair with Bitcoin. It's one of the most elegant things ever created, in terms, especially in terms of concept of forms of money, and it has proven to be an unbelievable asset from a speculative point of view, meaning making capital gains from it. Why? It's finite issuance. These are all very well-known characteristics of Bitcoin. The mining cost, again, one of the sort of beautiful, elegant points about the construct of Bitcoin is the mining cost is more or less an increasing function of time. As the difficulty rate goes up, it gets more and more expensive to mine your marginal coin. And with very few exceptions over the history of Bitcoin, it's largely been an increasing function of time, which means that to increase your supply, the cost of that marginal supply is only ever going up over any significant period of time. So a little help along in the right direction. Also, from a speculator's point of view, is like, how do I actually? It's hard to say that Bitcoin's overvalued, because what is the value? Very hard to determine this. And I have I'll talk about a few scenarios in just a second over where does Bitcoin go depending on what role it actually plays in this going forward. Finally, any student of markets would jump on this immediately. Bitcoin has had the dual effect of FOMO and confirmation bias. FOMO meaning, like, we've all known somebody who's made a fortune off of crypto and Bitcoin, and we all want to get in and be part of it. And it's hard to watch something go up and up and up and not own any of it. And the second part is, especially for those advocates that have really become huge supporters and zealots for the case for Bitcoin, is confirmation bias. So if Bitcoin was just flat or it was declining in price, psychologically it becomes very hard. You start to weaken your conviction that it is a form of hard money and that it is more than a speculative asset. As its adoption grows and the ownership broadens and the price appreciates, particularly when the price appreciates dramatically, confirmation bias comes into play, and it's much easier to believe, and everyone's conviction rate goes through the roof. And that we've very much seen this with Bitcoin in recent years. So the pragmatist in me, is less enamored of Bitcoin, and I will point out that Bitcoin is very good at it's a highly decentralized, anonymous system. And, there's counterpoints to all of these, of course, but it is very good at evading government oversight and interference. It was very much designed that way. It's a headless dragon. There's nothing for any government or any regulatory body to zero in on, because it's a truly decentralized system. Governments don't really like that. It's also very good at evading capital controls. There are various ecosystems that have evolved around the world for moving money through Bitcoin, transferring into real estate, crossing borders. And for those of us who live in North America, we have no capital controls. We've never seen it in our lifetimes. We haven't lived with it. But for much of the world, you can't move money out of your home currency. In many cases, you can't move it out of your country, period, or there's strict limitations on it. Some of my businesses operate in countries where every transaction where we're moving hard currency out of the country requires central bank approval, even paying relatively modest invoices. So Bitcoin gets you around all that. So that's great. That's a great feature of Bitcoin. It's also something that governments don't like, because it disrupts how they function and how they control things. Finally, it is also useful for not paying taxes. In a couple ways, peer-to-peer transactions. It is much easier to use an anonymous, decentralized system for peer-to-peer transactions in a world, particularly where it's increasingly digital transactions done through banks or other intermediaries in the conventional financial system, where there's an audit trail that would suggest that you would have to pay or remit taxes on that transaction. And also, again, going back to point 2, evading capital controls, moving money to jurisdictions where there is a low or no tax rate out of your home jurisdiction. That's another thing that Bitcoin's very good at accomplishing. Again, another thing that governments don't like at all. So all of that, add all that up and throw that in the blender, and also take note of the fact that central banks and governments, sure, they've seized some, and in some cases, some governments have even made open market purchases or even mined their own Bitcoin. But for all intents and purposes, they don't own any of it. It's tiny compared to literally trillions of dollars now owned in gold. So from a starting point, not good for Bitcoin in terms of the case for being the world's neutral reserve asset. Doesn't take away any of the speculative interest or any of the merits from Bitcoin. Conversely, talk a bit about CBDCs and coming to a theater near you, and very soon, central bank issued digital currencies. So this is, could be on-chain cryptocurrency version of regular currencies. So what's the difference? I'm like, all of my transactions are electronic as it is. They're in a bank account. I don't use any cash. It's all digital as it is. What's the difference, right? Big difference. So a CBDC, you have complete transparency. Still, the current system may be digital, and maybe there's an audit trail through financial institutions, but it's still analog money. It's still cash. CBDC, truly digital cryptocurrency version of your currency issued by your home government. complete oversight and transparency, kind of the opposite of a truly decentralized cryptocurrency. Not kind of, absolutely the opposite. Absolutely and completely effective capital control. So you want to send $50,000 or $50 million to the Bahamas and hide it in some sort of tax haven, or do some sort of transaction like that? Good luck. Impossible. The government has complete visibility on your transactions, and they can allow it, disallow it, haul it back, do whatever they want. So, forget it. If you want to do that, go do it now. And finally, no black market economy. So there's the black market economy, which is bad guys doing bad things. And then there's the normal course black market economy, which is you might want to pay a service provider in cash, and maybe nobody pays any taxes on the transaction. Well, again, forget about that. This is all absolutely transparent to the relevant government entities. Tax will be calculated and will be paid on every transaction. So all of these things that governments love, the opposite of a truly decentralized, beautiful cryptocurrency like Bitcoin. So something to keep in mind is, again, the pragmatist in me says, I love Bitcoin, and boy, did society really accomplish something by creating this thing and propagating it the way we have. But governments, I think, will continue to exist. And for the most part, for as much as we hate our governments from time to time, they're there to do constructive things for society, and they function by collecting taxes and imposing rules and controlling things. And the key, underpinning everything, all of their control over these economies and over society is through money. And if they've lost complete control of money, then they can't control anything, and they will cease to exist. So I don't think that's going to happen. And I think a CBDC, it just checks every box for every government in the world. It's an absolute dream for them. So we've seen large scale trials. China may very well be the first huge economy that transitions to a CBDC in a big way. They're certainly very well set up for it with what they've done in terms of payment systems and forcing the entire country to use things like Alipay and WeChat for financial transactions. The table is set in China in particular, but coming to a theater near you, we will see this in the very near future. So back to Bitcoin, then what happened? So I kind of break it down again, a gross oversimplification, 3 ways to go here. Number one, it is the, or one of the, doesn't have to be the only one, but it becomes one of the world's neutral reserve assets. So it's an alternative or substitute or complement to gold. This is your max price scenario. So now it's a neutral reserve asset. Currencies are partly or fully anchored to Bitcoin, and let your imagination run wild. The price could be very high in that scenario. Number 2 is it's this highly decentralized digital asset, finite supply, store of value. People like to pile into it when it looks like we're increasing the denominator, blowing up our money supply, i.e. inflation. That's our current scenario. So again, price could go much higher. It's going to be subject to the kind of volatility for sure that we've seen in recent years. But again, it could be a very good situation, or continue to be a very good situation for Bitcoin. Number 3, and this is a bookend in the other direction, is it's deemed irrelevant because we've gone to a sound money system that explicitly excludes Bitcoin. So let's say one that's completely and solely anchored to gold. So we now have sound money. We don't have to worry about it so much anymore. We have a set gold price. What do we need Bitcoin for in that scenario? Or worse, we're in that scenario and governments have converted their currencies, maybe anchored to gold, maybe partially anchored to gold, maybe not anchored to anything yet, to CBDCs. And in that scenario, maybe now they find Bitcoin an annoying competitor and quite contradictory to what they're trying to accomplish with their CBDCs. And they make it more difficult to transact and function, or even illegal in some ways to use Bitcoin. So that would be your negative price scenario. I think all of these are on the table right now, and not insignificant percentage probability of happening in scenario 1, 2, or 3. My personal bet is it's number 2. I don't see it becoming one of the key world neutral reserve assets, not at a central bank level. but maybe at an individual level, it continues to be that. And that kind of lands us into scenario number two, which may very well be positive for Bitcoin. But wait, there's more. So on the topic of cryptocurrencies, I think, as we just discussed, the future of Bitcoin, let's say, it continues to be uncertain. It's up in the air. There's a lot of debate and there's a lot of polarization on both sides of that argument. But what is increasingly clear is that other forms of cryptocurrencies, and not necessarily CBDCs, are becoming a very big part of the global money system. And I'm speaking specifically about stablecoins. And, we've seen the rise of Tether, to a lesser extent, Circle and others, a passage of the Genius Act. And again, just like we've seen with gold, an explicit endorsement and acceptance of stablecoins by the prevailing administration in the United States. Something very new. We've heard positive noises, but nothing so explicit and so specific as the Genius Act, which is really legitimizing stablecoins. Now, why is that? And why are stablecoins so important? I mean, the raison d'etre once upon a time for Tether was as kind of an intermediary currency for trading in and out of Bitcoin and maybe what other cryptocurrencies you wanted to trade between. That's really not the case anymore. Tether has become so big that it is like a systemic risk. It's a major player. It's creeping in towards the top 10 in terms of treasury holders. So it's very significant to the world money system in that sense. Increasingly, transactions in emerging or frontier markets with broken currencies, high inflation environments, a lot of difficulty in opening bank accounts, particularly transacting ones where you can transact in US dollars, are turning to stablecoins and turning, in many cases, to Tether. And so think Bolivia or Venezuela, or certain economies in Africa where you may very well want to transact in a stable currency, i.e. the dollar, and peg the value of everything that you're buying and selling, the services you're providing in dollars. But you don't have access to the global financial system and FinTrack and clearing anti-money laundering laws and trying to process wires of US dollars. It's difficult. It's not inclusive. A vast majority of the population cannot do that. And it's expensive. And so let's imagine you could do all of this in US dollars and you could do it with no cost and you didn't even need a bank account. That's stable coins. That's what people are accomplishing with Tether. And guess what? The US government doesn't just tolerate it. It actually likes this. This is actually propagating the US dollar even more so, increasing the demand for US treasuries, all unambiguously good things for the United States of America. So you have a very sophisticated set of bureaucrats in power from a financial perspective that are very much aware of what is happening and are explicitly endorsing it and allowing it, and not just allowing it to happen, they're explicitly endorsing it. So very positive loop there for stablecoins, for Tether, Circle, and others in that genre, and increasingly an important part of the global financial system. Just one factoid that's not insignificant: global remittances, and this is foreign workers in developed markets sending payments typically back home to family members, and different reasons as well. Huge frictional cost. The average cost is over 8% by the time it gets from the market where it's earned into somebody's pocket in that emerging market that they came from. And that is just money that's just lost to financial institutions. It's transaction costs. It's just lost money. That same transaction can be accomplished with Tether. There's no risk, or other stable coins. I shouldn't keep saying Tether. It can be accomplished with stable coins at no cost, and you don't even need a bank account. And it's just much more effective. The user experience is better. Everything's better about it. So we will only see more of this. This is going to be a more and more important part of how money works around the world. So just to recap all of our points throughout the presentation and summarize and maybe make some predictions or some takeaways on what to do with this viewpoint and with these thoughts. Number one, the starting point is the global debt problem is an intractable problem that cannot be solved with any realistic inputs. This is therefore a lose-lose scenario, a Kobayashi Maru scenario, and we are simply picking how we lose. There is no magic bullet or clever solution that solves this that's good for everyone or even good for a majority of people. So it's how do we lose in the least worst way? And number three, the most politically palatable and I think the most probable path to losing and the least painful path is the path that got us out with different characteristics because it's a different time with lots of different variables, but in many ways the same path that got us out of the debt problem that we were in coming out of World War II, which is negative real rates, significantly negative real rates for a prolonged period of time to deflate the debt in real terms, cause huge amounts of inflation, and fix that in a very painful period that will be damaging to the vast majority of the economy and hugely beneficial to a small sliver of it. And that's the final point, number four, is how do we keep ourselves in that small sliver that's going to benefit and in fact benefit substantially from it? The most obvious one, I keep coming back to, and I've very much designed my own investment, personal investment, family investment around, is gold. So we may very well be able to make more money from Bitcoin or other cryptocurrencies. There may be other opportunities and other real assets. It's not maybe, there for sure are other opportunities. But I have a very high conviction that gold is one of the ways to not just circumvent or protect yourself, but actually benefit as we have this huge one-time structural revaluation of gold that we look like we're currently in. And you can participate in that in many different ways. You can buy gold bullion in some shape or form. You can make investments in royalties on gold production. There's a whole universe of listed companies that professionally manage and grow portfolios of gold-based royalties, and that's an additional degree of leverage on participating in appreciation of gold. And then finally, invest in the equity of gold producers, so mining stocks and miners that are producing gold. And this, in many ways, is the most levered because you have an operating cost and you have a commodity price and hopefully a positive margin. And when gold goes from your operating cost is $1,500 to $1,800 and your commodity price is $2,000, you have a totally reasonable margin. And then gold goes from $2,000 to $4,000 and your cost goes up another $50. You didn't get twice as profitable. You got 10 times as profitable because your margin exploded by a factor of 10. And at the same time, you go from an anemic multiple being applied to gold stocks because they've been out of favor for so long to a premium multiple. So at the same time that you 10x your earnings, you're going to take yourself from a very low multiple, say 3 to 5 times those earnings, to 10 to 15 times those earnings. So you get two big wins happening at the same time. So potentially explosive upside. And that's very much what I've structured my largest investment, which is in my own gold mining company, Golconda Gold, very much designed to do 2 producing mine, or 1 mine in production, the second one soon to be, in terms of the global cost curve towards the high end in costs. But that actually just gave us more leverage as we've gone into this appreciating price cycle on gold. So with that, I will turn the presentation over to the listeners and to Marilyn to answer any questions.
Right. Thanks, Ravi, for that very insightful presentation. Lots to unpack there. This is now the not the exciting part of the session. It's Q&A, getting questions from our attendees. And just a reminder, you can attendees, you're welcome to post your questions in the Q&A box in your webinar screen. We have a few questions here coming already. First question, Ravi, what about devaluing US dollar and use crypto or gold to pay off debt as the price of gold and crypto go up?
Yeah, and I think using crypto, like that's definitely on the table. So crypto or gold or some combination of both. And that's very much, I think, what's the debate between the two camps. But in either case, it's a return to sound money. So anchoring money, in particular the dollar, to something that you can't print more of. And so there's that hard lock on money printing going forward. So you have to have the rip the Band-Aid off part in between. You get one kick at the can, so you got to probably overshoot. Like I said, you got to set the price way high to make sure you get it right on the first go. And kind of not ironically, but not uncoincidentally, the higher you set the price, at least in the case of gold, which is legislated into how the Treasury accounts for money, you get this huge windfall and infusion of cash into the government's bank account. And that is, it's just money out of thin air. And so that is money printing, that is increasing the denominator, and that causes rampant inflation, but it deflates that debt as a percentage of the size of the economy. So that's definitely my prediction of what happens. The exact mechanism of how it happens and the price levels, I don't know. You're not specifically using the crypto or using the gold to pay off the debt. You're just resetting the price and now anchoring at a higher reference point and basically implicitly blowing everything up or explicitly blowing it up. And the more real example I give people is, if you had a house that's $1 million right now and you have a $500,000 mortgage, maybe that's fine. Maybe it's too much of a mortgage. But if I blow up the value of paper money by 80% and your house is now worth $5 million, it's still the same house. And I don't think you're any richer. You still have the same house. It's probably a really nice house. But your $5 million house against your $500,000 mortgage, it's still a $500,000 mortgage. That looks a lot better than $500,000 against your $1 million house. And that's what we're talking about doing here. So who gets hurt? It sounds like it's a great solution. Everybody wins. Who doesn't win? The person who doesn't own a house is the first person who doesn't win. The person who holds that debt, who's like, well, I got this $500,000 of debt. That's great. It's paying me interest. I own mortgage-backed securities, bonds. I get a 5%, 7%, 10%, 2% interest rate, whatever it is. I'm getting some sort of return. That party is really destroyed. So oddly, owning what's supposed to be the safest investment, fixed income investments, bonds, basically forms of cash, is what gets hurt the worst. And that's your saver. And that's sort of the lower end of the middle class, even the middle end of the middle class. That people have worked hard, saved money, paid off their student loans, paid down their mortgage. They're the ones that are hurt the most. People who are super wealthy, who have hundreds of millions or billions of dollars of borrowings and own real assets, they make out like bandits. And so that sliver at the top benefits disproportionately, vastly disproportionately. And the people at the very bottom of society's pyramid, they get hurt pretty bad because their salaries don't move lockstep with that inflation. So that, I think the questions hits it right on. This some version of that is what's going to happen. Details to be determined, but position ourselves to be not only protected in this scenario, but to somehow benefit.
Thanks for that. Another question. My issue with Bitcoin is that no one knows who Satoshi is. What happens if or when that very big bag on the wallet comes online and Satoshi decides to sell?
I think that's a trading factor. Like it would be an enormous amount of supply. For all we know, it's completely lost, and it may never come to market, or it may come to market all at once on one day and just knock the price of Bitcoin by 90%. Anything's possible. I still think it doesn't change. The fact that the supply, not just the total number outstanding, but the supply available for trading, the free float, as we call it in the stock market, has been constricted, has definitely benefited the price. But conceptually, it doesn't change anything about Bitcoin. So either Bitcoin is going to be something that's systemically relevant, and that's your max price scenario, or it's going to continue to be a speculative asset, in which case it could go to anything up and down, or it's going to be outlawed, and the powers that be are going to come after it because it's an annoying competitor and a kind of a good one, and they really come to shut it down. And the Bitcoin maxis will say, you can't shut it down, it's decentralized, governments can do lots of stuff to make things difficult. So you can't shut it down, but you can really damage it if there's a concerted, coordinated effort to do so. So any of those is possible. I think the supply dynamics, that's a big negative if like the Satoshi wallet were to open up and spew all those Bitcoin into the marketplace. But it's really just it'll get absorbed and the price will reset to whatever it's going to reset to. On balance, definitely short-term negative. Doesn't change the long-term equation for Bitcoin. Still beautiful, elegant solution. Will it be here, or here? To be determined.
Great answer. Another question. What do you think of XRP in comparison to Bitcoin and Ethereum?
I personally, I do not have any views on one cryptocurrency versus the other. I think again, my education is in mathematics, so I've in computer science, so I have a love affair with them in general, and Bitcoin in particular. But the only thing that's clear to me is the relevance right now in cryptocurrencies is the increasing importance of stablecoins. Doing all sorts of positive things, unambiguously positive things. And I think they were viewed with a lot of skepticism 3 to 5 years ago. And now they're actually, being viewed as like, wow, this can really improve access to the global financial system for many, reduce costs, and just benefit everybody except for those who are collecting those fees as intermediaries. So that I have a high conviction on. I have a high conviction that governments will be issuing their own digital currencies. It just checks so many boxes. It's an absolute dream for them, things they'd like to accomplish. So I have a high conviction that's going to happen. What's going to happen with the 101 other cryptocurrencies that are out there? I don't have a strong view personally.
Let's talk a little bit more about the sort of the gold's, as you mentioned, the gold's remonetization. For maybe new investors or the people that are just starting to learn about this, can you explain what that actually means in practice, and how do you see gold's role evolving as digital assets become a larger part of the global financial system?
Yeah, so gold is compared to silver. So it's a natural comparison because they're both monetary metals, both precious metals, and have various similarities. Silver, a huge percentage of silver demand is for using it for stuff. So solar panels, other different applications, and the energy transition. Huge, the laundry list of things where silver is actually used and is a critical ingredient or input. Gold, not really. So yes, it's in all of our cell phones, it's in high-end electronics, it's in quantum computers. It's a tiny percentage of the actual demand of gold or the annual gold production. What happens to most of gold? It's just a store of value. So it's bracelets on somebody's arm, or it's sitting in a vault in Switzerland. It's not doing anything. And they say, well, that's pretty negative, isn't it? Silver has all these great uses, platinum's great uses, copper, nickel, zinc, whatever. Gold sounds like it's useless. It's actually a feature. So the economy could go to zero and you don't really have any significant demand destruction for gold because it's not really useful for anything. It's just truly a monetary metal. And the fact that it's not useful for anything is one of the key features that allows it to be money. If I took the price of silver and I put it 10 times higher, that would create a lot of problems for most of the industrial demand for silver. It would now be too expensive to make certain types of solar panels. So it would be too expensive to make certain types of electronics. It would destroy the demand and those industries would suffer. I could 10x the price of gold, nothing. I'm still going to buy a cell phone. The price went up $5 or something because of the tiny trace amounts of gold in it. So that's an important thing about gold in terms of understanding, like, why is it gold? Now we come to the question of, like, how does this actually happen? And like, what does it practically mean to make it money again? And what does it mean, in terms of digitization of assets? I think gold is like, it gets characterized as a relic, and it is, and it's inconvenient. And you have these bars sitting in vaults, And if I try to settle trade, I got to move bars around in like ships and this is it's the year 2025. What are we doing here, people? Well, guess what? There's a solution for that, and it's a very real and very practical solution, which is a digitization of gold and putting that gold on a blockchain and creating a large and liquid tokenized version of that gold that's maybe stored in various centers. It doesn't have to be just one country, or even if it's a neutral country like Switzerland. It can be stored across multiple locations around the world that are financially relevant, tokenized. And guess what? There's various parties out there doing it, not the least of which Tether. And Tether, I believe, recently just crossed $2 billion in terms of tokenized gold in XAUT. And my understanding is they also own over $10 billion of gold on their own account. And that is something that's only going to grow. And what's the significance of that? Well, right now, let's say it trades tens of millions or hundreds of millions of dollars a day. In the global perspective, that's your like definition of money. That is way too little. But it's early days. Like, let's fast forward 2, 3, 5 years from now, and it's trading billions or even hundreds of billions of dollars in daily volume. And it becomes a completely liquid instrument. Now I've really reduced the impracticality and inconvenience of gold as the anchor to my system of trade and my definition of money. I've all those X's against gold that were check marks for Bitcoin or other approaches, or more digital approaches. They're now check marks. So I've got all the beauty of and the physicality and the history of gold, and now I also have the convenience of it being made mobile by making it digital. So that is, I think that's the other really significant development of 2025 is and guys have been sort of trying to do this for like 10 plus years, maybe even 15, going back all the way to the financial crisis, a digital version of gold. And some guys have done a pretty good job of it, but for it to be relevant to gold, it has to be just like Tether's done with the dollar. It has to be huge, has to be super liquid, has to be beyond question. So we're talking everything is like billions or trillions. And it has to be a totally unquestioned trading partner, and most importantly, super liquid and super trusted. So that's now happening. Tether Gold, that might be the first foray into it. Maybe there are others behind it. But as long as there's a couple that achieve this, high level of trust and high level of liquidity, it's really going to help facilitate a transition to gold, again, being part of the anchor of our global monetary system.
Thanks. Here's an interesting question. Isn't the rising energy demand from Bitcoin a problem in the future?
It's been highlighted as an issue, and it is the energy demand of the Bitcoin network is already enormous and impactful. It is also almost kind of the definition of the value of Bitcoin. So you can't cheat, just like, you can't cheat a bar of gold, you can't cheat and print a Bitcoin out of thin air. You have to expend a lot of energy to get that Bitcoin, and that energy ultimately equals money in whatever, maybe it costs you dollars to buy the electricity, to buy the mining gear required to create that new Bitcoin at the margin. But whatever the input was, maybe in the future it's not dollars, it's something else. It's money. Like energy is money. So I think it's really part of it, and it's not great because of course we don't want to just frivolously use electricity and use less electricity, use more renewables, all that sort of stuff for sure. But it's intrinsic to there being a sort of hard value to that Bitcoin. I can't turn the Bitcoin back into electricity. Fair. So that, okay, you could argue that's inefficient, but it's in theory, in principle, it's in that Bitcoin. It's energy, and that is something I can't cheat. So it is a factor, and I can tell you because I'm also been involved in the renewables industry and power generation for the last 15 years. Our global energy production capacity is just going to keep going up. So adding renewables, getting more efficient with fossil fuels, adding new types of renewables like geothermal, tidal. All of these things initially, they're not economic and they get pilloried because, oh, that doesn't make money and, it's, too expensive. It can't compete with gas or oil. And then the technology gets better, the production gets larger, so the costs come down. And one day it's cost competitive, the next day it's superior. And if you put a solar panel in a place that's sunny, you can't compete with that. That is free energy and it's highly cost competitive. It's cheaper than the cheapest coal or gas. And the same goes for wind. And the other technologies will get there too. So fast forward, like we're on a trajectory here where we're going to generate so much electricity that all this demand from data centers and cryptocurrencies, yeah, it's it'd be great if we were just shutting down the fossil fuels and doing that faster. We'll still be able to do it slower because we all have this incremental demand with what society's doing in terms of computing power for all these different applications. But we're going to be fine. We're going to get there, and the technology is improving, and is like there's going to be so many options for us.
Yeah, that's interesting. All these things are happening and converging in that, the area of gold and then Bitcoin and then all these energy transition thing happening all at the same time. Another question, central banks aren't purchasing US treasuries as there's more focus on acquiring gold for central bank reserves due to the fiat currency devaluation problem. Can you speak to the use and mechanisms behind the use of stablecoins to potentially transfer the US debt onto the general population of the USA?
Yeah, I think, well, two things there. First of all, yeah, we have seen this shift to focusing more on gold for other foreign central banks' reserve additions. And I think, yeah, it's diversification away from the dollar, concern about the real value of those treasuries over time and that negative real rate factor. That means you're just losing, if you're holding those treasuries, you're just losing value every minute that you own them. So that's a factor. The second big factor, not insignificant, is what we've seen in terms of the weaponization of the dollar. And big signpost was Russia invades Ukraine. Whatever your opinion on that, it's irrelevant. Russia held a lot of U.S. treasuries, which were basically seized by the U.S. government because the U.S. government disagreed or didn't like what Russia did. And so that means to Russia and to anyone else who owns U.S. treasuries, meaning foreign actors, whether it's company, individual, or country, that if I do something that the U.S. government doesn't like, maybe they just cancel all my money. So it's not really money then. I can't put that as a zero risk reserve. I have to be at least a little bit concerned. And if I'm somebody like China, I should be really concerned. I shouldn't own any of these things. So that's hastened the move away from treasuries towards gold and presumably other forms of money as well, but most notably gold. In terms of using stable coins to push the debt onto the U.S. citizens, I think I wouldn't look at it as pushing a debt onto anybody in particular. They have to keep issuing treasuries. There has to be buyers for the treasury. So it can't, the buyer of last resort is the Federal Reserve, and it's confusing. You have these two entities, the Department of the Treasury, their Treasury Department, and the Federal Reserve Bank, and they're very much separate. And it could be the Treasury Department issuing new treasury notes and the Federal Reserve buying them. So effectively, like the Federal Reserve is everybody in the United States, and you're effectively pushing it on each man, woman, and child in the country. But you also want to create other demand. And the beauty of what's been happening with stablecoins is you're increasing the facility and the usefulness of the US dollar and the accessibility to it through stablecoins. So now people, let's say, I'll pick a country, Bolivia, who couldn't open a bank account where you could transact in US dollars, or it'd be just too expensive or complicated to actually conduct any transactions, if they could even do that, are now able to transact quite easily in US dollars using stablecoins. So that's increased the demand for dollars. That's good if you're the US government. So you now have more Tether, more Circle, more whatever stablecoin issued. And they build that up, and they have to cover that with their reserves. And the reserves that cover those new coins that they've issued are, for the most part, treasuries. So you fast forward to where we recap this 1 year from now in 2026. I mean, Tether will be one of the 10 largest treasury holders for sure. And that's viewed as a good thing. That's a new source of demand for treasuries. That's good for the Treasury Department and for what they hope to accomplish, which is to issue a lot of treasuries.
Right. We're nearing the end of our webinar. Maybe as a last question, and obviously you're the CEO of Golconda Gold. Maybe talk a little bit more about how these global trends are influencing how you're building Golconda, that company, Golconda Gold today, and what's the long-term vision for the company within this changing landscape?
Absolutely. And I alluded to during the presentation, Golconda Gold was very much founded by me, and our strategy has been to sort of manifest my investment thesis, which is that gold would be remonetized. And as a function of it, I don't know what price it's going to go to, but the direction is much higher and the quantum is much higher. And so if you have a very levered, I could just buy bullion, or I could buy operating assets that give me that super leverage to the gold price. So not just sort of we'll call it moose pasture in the industry, like ground that maybe there's some gold in there, maybe there's not. Actual production assets, which gives me tangible leverage to gold that just shows up on my financial statement every quarter. So we've done that. We've bought 2 past producing mines, so we removed the permitting risk, the environmental. Remove the risk that there's any gold there. There's gold there. They were just companies that failed for financial reasons during bad parts of the cycle. So I sort of took out all those risks, and then I had execution risk and financing risk to put them back into production. And in one case, checked both of those boxes and on its way. And in the second case, currently climbing those walls and checking those boxes. In middle of next year, we'll be on our way on that one as well. So that will be, if we do anything else beyond those 2, it'll be more of the same. But it's really getting that operating leverage to the gold price. Like I said, if you had a cost of $1,800 and a gold price of $2,000, you had a $200 margin. And now gold's gone to $4,000 and your operating costs went up 10%. You now have a $2,000 an ounce margin. You 10x your margin. So you're 10 times as profitable for the exact same amount of work, the exact same production. And at the same time, the multiple on gold stocks is going from the lowest of any sector in the entire investing universe, 3 to 5 times, just nothing. Nobody cares. Get lost. Don't want to hear about you. To fast forward a year or 2 from now, and I think it'll be bordering on mania, and you'll get an absolute premium multiple, 10, 15, even top of the market type 20 to 30 multiple. So you're going to get as much as a 5x lift on your multiple and a 10x lift on your earnings. That's a 50x lift for investors. So that's for the same move that got me a double on gold price. Over a few years, I could get 50 times my money as an investor in that kind of operating company. And that math is tangible and it's very real.
Right. Amazing. Thank you. And lots of insights today, especially for me, who's just learning about, how gold is being remonetized. Thank you, Ravi, for your time, for answering our attendees' questions. And to our attendees, thank you for joining us today. As again, we have a recording of this webinar, and we will be sending all registered attendees the recording for your on-demand viewing. Thanks again, Ravi, and thanks everyone for joining us.